My name is Bill Whitehurst. The name of my firm is Whitehurst Mergers and Acquisitions. I'm headquartered in Dallas, Texas. The core activity of my business is representing business owners in selling their companies. A main question that business owners frequently ask me before they get ready to sell is, how do I determine the value of my company? What is the methodology encompassed in doing that? Before I start with evaluation principles, let me first say that business owners frequently make one of two mistakes in learning how or attempting to determine the value of their company. One of these mistakes is listening to other business owners that have previously sold their company. It's hard to determine just exactly what the apples to apples are in one business sale to another. For example, the components of a business sale may include elements of the balance sheet. Cash may have been included in the transaction. The accounts receivable may or may not have been included in the transaction, which of course increases the price. Real estate may have been owned by the owner and was conveyed in that transaction. Frequently, when one business owner that sold his company talks to another business owner thinking of selling, all of these elements were not discussed, the components of that sale, which would drive up or lower the price. Therefore, business owner getting ready to sell could get confused and misled. The other mistake of business owners make, and talk about value in their company, is listening to rules or industry rules of thumb. That is, on what the specific industry guidelines are in value in a company. One is what a customer is worth, what a customer route is worth, or route of customers. These are usually very misleading and inaccurate. The correct way in value a company is using the income approach. It's the universal accepted method throughout, regardless of the size of the company. And that is, the income approach is a multiple of discretionary earnings. When a business owner is getting ready to sell his or her company, that business owner should be well advised to first learn the terminology and understand how that terminology goes into the evaluation process. Some of that terminology is, one, EBITDA, which stands for earnings before depreciation, taxes, interest, and amortization. Another is adjusted EBITDA, which is EBITDA but adding in the seller's owner compensation, W-2 wage. The other is owner's discretionary cash flow, which is all of the previously mentioned EBITDA, adjusted EBITDA, plus quantifiable owner's perks. Owner's income or cash flow is everything directly or indirectly that owner takes out of the business. A multiplier is assigned appropriate to the size of the deal to the adjusted EBITDA or owner's discretionary cash flow, and that multiple, that derivative, is the selling price. The best people that are in position to be able to assist the business owner in determining the value of his business are the people that are out on the street selling companies every day, that understand the current multipliers and how they're utilized in the sale of a company. Many business brokers, such as myself, do not charge for rendering a broker's opinion of value, where the business owner is getting ready to sell now or many years down in the future. Baseline needs to be established and good information needs to be given for which the owner can then go forward in his or her planning exit strategy. My name again is Bill Whitehurst. The name of my firm is Whitehurst Mergers and Acquisitions, and I'm in Dallas, Texas.